Okay, I think we'll kick off. Anyone joining a little bit late will just miss my intro, which isn't the end of the world. So welcome to another one of our webinar enterprise series. What does the economic outlook mean for my business? And like I said, we've had a lot of registrations this morning, as understandably this is a very popular topic and probably the forefront of a lot of people's minds from a business as well as a personal point of view. There are lots of familiar names on the attendee list, a few slightly less familiar ones, and most of you probably know who we are, but for those of you who don't, Wilkinson Smith are a UK top 15 audit, tax and advisory firm who work with lots of entrepreneurial businesses across all different sectors, as well as lots of not-for-profit and private clients as well. We're part of More Global, which is an international network with presence in over 100 countries, and that allows us to give really joined up advice to our clients who are looking to expand internationally and fulfill their international growth ambition. So yeah, so the UK is definitely in a period of economic uncertainty, even more so since Truss's mini budget. Factors such as inflation, rising interest rates, the war, rising cost of electricity and gas, all playing into that. And the government's still yet to announce their full package of measures to help support people through the cost of living crisis, whatever that might actually look like. So this session is looking at what is to come and how you as a business can prepare and how you can help your people as well. So we have a panel of speakers this morning who you can all see that are going to take us through this topic. I'm particularly delighted to have Peter Doherty from Arbuthnot Latham join us. Peter is head of research at the investment team at Arbuthnot and provides macroeconomic and market research to the investment committee for the management of their client portfolios. So is extremely well placed to join us on these discussions this morning, as obviously he's a bit of an expert on economic outlooks. And then obviously we have some of our usual MKS panel members as well. So we have Tim Stovold, head of tax, we have Dan Lehman, who's one of our corporate finance partners, and Zainar Patmore, who is one of our HR consultants. And they'll be taking us through how your business can prepare and how you can help your people as well. So before I hand over to Peter, who's going to start us off, just a couple of housekeeping points. Please do ask questions. It's much more interesting if it's interactive, but please do ask them in the Q&A function because it's much easier to keep track of them there. I'll try and weave some questions in as we go through, but there'll be a little slot for questions at the end as well. Please do fill in the feedback survey that will come at the end. It's super, super useful. It's really short, but it is useful in helping us shape future webinars. And also this webinar is being recorded and it will be available to everyone afterwards. So please do share it with your peers or anyone who was unable to attend today, because I can't imagine that there's anyone to whom this topic would not be relevant. So please do share widely. So, okay, we will kick off then. So I guess the rest of the panel, if you want to turn your cameras off, feel free. I will turn mine off as well. And I'll hand over to you, Peter, for what feels like a rather large question. What is the economic outlook in the UK?
Yeah, that's great. Well, firstly, thank you so much for inviting me to talk today. And yeah, massively challenging question. So before I get on to the UK, I thought I would just go over a little bit more globally, which is, I think, one of the key pictures which will influence the UK as well in coming months and into 2023, 2024. I'll focus a little bit on the US and what's driving their economy and interest rate policy, moving across to Europe, focusing on the energy crisis, and then finally on the UK. I won't be going to China, but I think it's important to note when we start off that the UK isn't alone in its problems, either from an energy perspective, inflation, interest rate cycle. This is a truly global phenomenon. And then what we have in the UK is something that's been overlaid very recently with government policy, which has created close to systemic risks within the UK, unfortunately. And so if we rewind back, I'll start off with the US and sort of thinking about what's gone on and what's driving their policy currently. And that will help contextualize a little bit of when I come to the end of this, where I think some of the hopefully light at the end of the tunnel is present. And so if we think about, really the economic cycle as it's going on currently, and our analysis within the investment team here, we could see that coming off 2021 into 2022, growth was very elevated, and that was following the COVID boom. You had inflation, which was somewhat a problem, but you had most commentators thinking that this was going to be somewhat transitory in nature, i.e., once we work through all of the COVID boom factors, it would just settle away into the background. And as we turned into 2022, the key factors that started impacting markets were that we started to see global leading indicators go from highly expansionary and start to tilt downwards, i.e. still expansionary, but they were on a downward trajectory. And at the same time, inflation globally, but particularly in the US, was not coming down as much as the Federal Reserve might wish. And it was actually spreading out into other parts of the economy, which we refer to as sticky inflation. And these are typically inflation points which are linked to wages, linked to services, linked to housing. And so as we come into the year, the Federal Reserve in the US completely changed its monetary policy and quantitative easing policy that it's basically had in place for the last decade. Low rates, easy money. In December, they announced all that was going to be reversed, and they were going to start fighting inflation. And what's happened through the year, and what's created a lot of volatility in asset prices and contributed to a slowdown in many areas of the economy globally, is the Federal Reserve has gone on one of the fastest and most aggressive hiking cycles that we've seen in the last 50 years. And as this has sort of precipitated through the year, inflation, core inflation, has actually become stronger, stickier, more resilient. So the exact factor that the Federal Reserve is fighting seems to not be going away. And so when we think about core inflation, you take away cyclical components, you can think of used cars or commodity-led inflation, and really focus on those which are ingrained within the economy in things like housing, in things like wages. And so that's been a huge area of disruption. That the US and US interest rates are really one of the key starting points for all other global assets, whether that be equities or debt. And so their shift from being very accommodative to being extremely tight in their monetary policy through raising interest rates was a huge change. And so as we look forward in the US currently, we still have very high inflation. Mortgage rates have gone up to an exceptional degree. We can see huge cooling in the mortgage market there. And the economy there is rolling over. The leading indicators that we track show it's starting to soften. But the risk here is that the Federal Reserve, and this goes for Europe and the UK as well, they're hiking interest rates and will continue to have a tight monetary policy until they really break the back of inflation. And so this is quite counter to what we'd normally see. Is as interest rates are going up, economies would be very, very hot and they're looking to cool the economy. Here, they're just looking to cool inflation. And from an economic perspective, we can already see the economies rolling over. And so this is one of the key starting points for thinking about the global economy. Just generally, interest rates are going up in the US, affects all other asset classes, and there's really no end in sight. This is causing huge volatility in both government debt markets, in equity markets, and is one of the core reasons why the global economy is cooling. When we take that across to Europe and we compare it to the US, and whenever we get good news out of the US, i.e. the economy, inflation is high, but unemployment is at record lows. We have really good employment growth in the US, which it could turn in the next couple of months. And so whenever we get bad news in the US, i.e. inflation looks like it's going to soften, or the economy's going to go into a recession, ironically, that's been good for asset prices, good for equities, and vice versa when we have very strong readings, we've seen equity markets go down and debt markets go down. In Europe, it's been quite the opposite. So we're dealing with different factors in Europe. Namely, we're dealing with an energy crisis, which was sort of underway and becoming a big part of the story in Europe before we had the invasion of Ukraine by Russia. And the reason why that was such a catalytic moment was because it completely changed the outlook for Europe almost overnight, in that where they were already constrained from an energy perspective, we could see energy prices going up. This was going to impact inflation, going to impact the industrial sector in Europe. It skyrocketed. And the feed through for energy prices into the industrial sector in Europe and then the consumer is really, really instant. And so within Europe and the outlook becoming darker and darker has been, it's highly likely that they're already in recession. Consumer confidence is at record lows. We can see from a lot of the business indicators that we track that business confidence, CEO confidence, forward-looking orders, the full 9 yards, is really already in recessionary territory. And alongside that, there is not yet a sort of light at the end of the tunnel. So one of the areas that we've been very focused on in our research over the last couple of months has been the outlook for the energy complex in Europe. And there have been some good things happening. So a lot of the industrial sector has managed to change their energy inputs from gas across to oil. We've seen consumers sort of rein in their consumption a little bit. And then just by virtue of a softening globally, the industrial sector has reduced their sort of utilization of energy as well. And so overall, we've seen less demand coming through. On the flip side, we've also seen supply become further constrained. Now, Europe has just gone out and tried to buy all the gas that it can, and it should do. It's a rich nation, it can afford to do this. And gas storage levels within Europe have gone to levels which create some sort of buffer going into the winter. One of the key issues for Europe, however, is not really this winter. It's looking into next year and how they're going to replenish a lot of the energy capacity into the summer and the winter next year, because we have to assume that Russian gas just is not going to come back on. And they've done a lot. They've created offshore storage capacity. France is bringing back on a lot of their nuclear after a maintenance period. And so there's some reasons for optimism. But unfortunately, within Europe, it really does boil down to, and any analyst that we speak to in the energy sector reaffirms this, it really does boil down to how cold the weather is going to be this winter. And a very cold winter will use up a lot of storage. And it's not so much a question of will demand stay robust. It's if demand stays too robust, then we could just run out of energy at certain points. And so there you have a key systemic risk. And this has obviously filtered across to the UK. Now, when we come across the UK, the same sort of factors that are affecting the US with regards to high inflation, raising interest rates, were already present here. We already had higher energy bills coming through before Russia, and the concoction of higher interest rates, higher costs, high inflation was crimping the consumer. So what was hoped for across businesses for a rebound in the consumer, a rebound in economic activity post-COVID, has really not sort of panned out the way that they would have hoped. The consumer confidence readings in the UK, like many other regions, are at all-time lows. Equity markets in the UK are highly correlated to consumer confidence, and I mean domestic equity markets, not the FTSE 100. And so this is just sort of been a really acute problem in the UK. The UK, opposed to Europe, has far less gas storage capabilities, and hence why we've had very extreme energy price spikes, and why the government stepped in to cap energy prices earlier than the European counterparts did. And so when we think about the UK, and we think about its forward-looking growth potential, we need to think about where interest rates are going, previously where energy prices were going, and then how the consumer is going to react to those things. So if we take the energy prices, inflation just would have flown if the government hadn't stepped in and done something. And so the energy price cap that they brought into place was probably needed, but there hasn't been much government communication. In fact, it's been the opposite of what we'd probably like to see with regards to explaining what you can do, i.e. reduce your energy consumption. The government's message has been, we don't want people to reduce their energy consumption. But the energy price cap was a game changer for domestic UK enterprise. It meant that we could have some security going through the winter into next year, and it transferred that risk onto the government balance sheet. And the key risk here for the markets and for gilts that we'll get onto was that the cost of the government is unknown. So it's dependent on where energy prices go through this winter and into next year. And when we have figures of it's going to cost the government 150 billion, if we have an easing in energy prices, then that will be very good for the government. It will mean less need to raise debt to finance this backstop essentially for the consumer and for businesses. But on the flip side, we don't know how high the cost could be. This was taken in a mixed way by the markets. Interest rate expectations went up as government funding needs went up. So the government needs more money, they're going to issue more debt, and the sort of interest rate that international investors demanded on that debt naturally went up. And so we already had one problem in the UK that the government had sort of dealt with, and it's a huge problem, the energy crisis. What's happened more recently with regards to the mini budget, which will go down in history as probably one of the largest missteps from the first few days in government, was a huge fiscal expansion, which is again funded by debt. Currently, we'll wait and see what comes out on the 31st from the government in terms of how they're planning to balance the books. But they decided to try and stimulate the economy in a relatively unbalanced manner at exactly the same time as they already had an unknown fiscal hole. And this caused huge volatility, as we all know, in the pound, in government bond yields. And it's sort of like we had one problem to deal with, which was the energy crisis. And now there's another issue, which is is government debt sustainable? Is this fiscal spending sustainable? And they're doing all this sort of growth spurge in the face of a global economic slowdown when there's a lot of these headwinds opposed to tailwinds behind the policy. And this comes into why financial markets, and I was listening to the speech by the Chancellor and watching markets as it was coming on, and they reacted so negatively so quickly, and now we know that was creating an underlying systemic risk within the UK, which is I'll come on to, I'm sure, in questions, which was with regards to defined benefit pension funds who essentially were at a risk if government bond yields on gilts were to have risen much further, were at the risk of imploding in some cases. And so this is a good analogy for the risks that might be embedded in other parts of the global economy from over a decade of near zero interest rates. You don't know how far the tentacles reach, but we're getting there. On the pound, obviously, it was very negative for the pound. It's not just a pound story, it's a dollar story. The dollar has been extremely strong. It's strong against all global currencies. And when we look into the future, we're trying to think about what can change globally and in the UK to make things a lot brighter looking into the future. And as we do, we need to imagine a future in the US where in 2023, inflation looks like it will eventually start to subside. This will be a catalyst for interest rate rises in the US to pause. The economy will likely enter a recession, but globally, the consumer's balance sheet is in good health, corporate balance sheets are in pretty good health. that should restrict how deep the recession becomes, unlike the global financial crisis. And within the Europe and the UK, we need to think forward to when the energy crisis might start to subside. And all of our research points to real supply coming back on the market towards the end of 2024 and into 2025. And when we look further out, there could be a risk of oversupply of energy, which sounds, a bit crazy at the moment. But if we build a lot of capacity that comes on in a few years, then it could look very, very differently. And so, there are some spots at the end of the tunnel for the global economy. Within the UK, it's going to be, unfortunately for all the listeners here, a lot worse before it gets better. And so, ironically, the stimulus provided by the government might actually start to become completely nullified by interest rate rises in the UK. So, one thing that I'd expect to happen over the next couple of months is the Bank of England come out and raise interest rates, and expectations currently between 4.5% and 5.5%. That means that anyone rolling on variable debt or fixed rate debt that's going to come off fixed term will face far higher interest costs into the future. This will thus likely crimp a recession as we go into 2023. The government is in a really difficult place. I'm sure we'll receive questions on this. And there's been a lot of backpedaling on their policy, and quite rightly so. It looks like the probability of Labour government coming in 2 years is increasing at an exceptional rate. The markets are doing their thing with telling the government that their policies are really not responsible in the current global economic environment. And so the whole global or the UK sort of political outlook is extremely volatile. I'll have questions about whether they're going to backtrack or not, I'm sure, but I'll pause there. I've sort of taken up a good amount of time. I don't want to overrun, Esther. But unfortunately, I think as we look into the end of the year, that the outlook for the UK is going to continue to be constrained. We're going to have to work through this winter as it comes to energy, and interest rate rises are going to be on the outlook. I can go into a lot more detail on other things impacting this, but I'll pass back to you, as I know we have a packed agenda today.
Thank you, Peter. We do have a packed agenda, but I do have a couple of questions that have come on that I think are best answered by you, relevant to your section. So somebody said that employment has been strong, but raising interest rates to curb inflation has the potential to destroy this and push us into a much deeper employment-led recession, which would have worse implications long-term rather than current high inflation levels. And they're asking, is this focus on raising interest rates the right strategy, or is it too short-termist?
Yeah, I don't think it's too short-termist. I think that if the government, there's lots of pockets of vulnerability within the UK economy and globally. But when you see this sort of fiscal expansion, if you look at emerging markets, for example, there needs to be a protection against it getting out of hand. And one of the solutions sometimes is a recession, to bring down demand. And in protecting the currency, if we were to dislocate from the US and Europe with regards to raising interest rates, the currency impact of that would be much more acute. The potential spike in government bond yields potentially a lot greater. And so although there's no sort of good solution to this, it would just there would be pain coming through a different lens, which would be the global investor community not trusting the UK monetary policy as well as the government, and gilt yields would likely then potentially get out of control, and the pound could weaken substantially further. And so you do need a very much independent central bank looking to control things like inflation, protect against a spiraling currency plummet, and without some sort of central bank, let's call it, usual policy to protect against that, I think we'd actually be in a worse position. You would still get that unemployment coming through one way or another.
Okay, thank you. And another quick one. If we're in a recessionary period, why is the labour market still very tight? I would have thought that given economic logic, unemployment rates should be or would begin to rise. Could it be the productivity levels in the UK seem to have deteriorated due to pandemic working ethics still existing?
Yeah, so there's a few things in here. One is that the sort of working population has declined. That's not just been a UK phenomenon. That's also been in the US and Europe post-COVID. But in unemployment or employment is the most lagging indicator. And so normally in the US and in Europe and everywhere else, as interest rates meet their highest level, that's when unemployment starts to tick up. So it's not unusual for employment to be the last shoe that drops, like the evidence that we are in recession. And normally by that time, when unemployment starts going up, you already have equity markets, bond markets, etc., have already priced this in. And so, I completely get it. Would we not see unemployment tick up? That's exactly what we'd expect to happen, both here in the US, as we move into 2023 and 2024.
Brilliant. Thank you very much, Peter, for attempting to answer what was a very big question, like I said. So I think we'll bring Dan in next, just to really talk about what businesses can do to try and strengthen their position. Over to you, Dan.
Thank you, Esther, and hello, everyone. I think contextually, it's important to recognise that we're going into this after coming out of COVID, which had its own impacts on businesses, especially with businesses that relied on, say, reserves and borrowing to get through the COVID crisis, and the same businesses may not have fully repaired their balance sheets from that, as we sit here now looking into the next challenge. So, I mean, the first thing I would suggest is that, as ever, cash is king. So if you haven't already got one, ensuring that you've got a 13-week rolling cash flow forecast for your business is the most important tool to enable you to manage the peaks and troughs and ebbs and flows of your bank accounts, so that you know when you think you can make payments safely. So that is a must. Feeding into that, the most important input into that 13-week rolling cash flow is your assumptions around when you will receive your debtor payments, assuming that you're not a cash business. So credit control, more than ever, is essential. I think I was reading earlier this week that there's record levels of insolvencies since the financial crisis at the moment. So you don't want to allow clients to be building up large debts and running into arrears, and you don't want to be caught out if any of them do enter problem territories, and you bear the brunt of that. So ensuring that the credit control is on it more than ever, ensuring that credit checks are being refreshed because companies' circumstances may have changed, and that credit limits are being monitored and set appropriately is really, really important to mitigate that credit risk as we go into a recession. So, as Peter explained, it's going to be a rocky couple of years for the economy. 2023 and 2024 are going to see higher interest rates and inflation and unemployment. So scenario planning on the longer range over that period is going to be essential for you to start thinking about how you're going to manage your business. I mean, one of the questions that I'm sure every business owner is wrestling with is, what pay rises can I afford to give my staff who are having to deal with these increased energy bills, increased food bills, increased mortgage payments, to retain my staff? And it's really difficult to answer that question without having a longer range plan, because once you give a wage increase, it's normally baked in and it's quite hard to roll back. So you've got to be thinking in the longer run about your business security. So your scenarios need to reflect the current realities and not just past trading. So things like, really important things to consider is that, you know, as Peter said, interest rates are going to be going up to say 5-6%. Therefore, if you have taken out a C-bills loan and it's on floating interest rates, or you have an invoice discounting line or an overdraft, they're all going to become more expensive to service, considerably more. I mean, businesses have got used to very low rates of interest, even once banks' margins are added on to base rate. So this is going to become a significant extra cost, and that needs to be built into your forecasts. But also, rising raw material costs are still being faced. We are probably coming into a world where, if you're B2C, you are already seeing customers tightening their belts, whereas if you're B2B and your B2B clients are B2C, then inevitably they will be facing that, and their corporate budgets for spend areas may be being squeezed, which means that they'll be having conversations with you about potentially less work being available, potentially asking you to do more for less, potentially telling you that they've had a cut in their budget and, you know, the service you're providing may be gone. So, you know, understanding your client's budgets and building that into your plans and having those conversations early, really important. Passing on planned price increases where this is possible is going to be key, because if your input costs are rising and you aren't passing that on, then your margins are going to naturally be eroded. But also, maybe in your planning, you should be thinking about increased bad debt expenses and exchange rate movements as well. So all of these different assumptions need to be built into your scenario planning and modeling. And because a lot of them are going to be unknown, you may well have a few different versions that you can use to plan. But what that will mean is you will prepare for all eventualities. And when you're trying to answer that question of how much can I afford, you know, you should be ensuring that in each of those scenarios, whatever you decide today is affordable, whatever happens, and you've got a plan on how you'll mitigate any adverse trading environment. I'd say the other thing I'd say that you should be thinking about is, if once you've done your scenario planning, you can link that to an integrated cash flow model. You can start to see if your headroom in the longer run is where it needs to be. And if that indicates it isn't, it will then tell you that your future cash flows need to be improved, which can be done one of two ways. I guess you can have another look and see if there's any additional cost that could be cut out of your business to right size the cost base for the future scenarios. And if that isn't the case, and you think it's just a temporary blip in trading that will recover, maybe you can, depending on your current financing arrangements in your business, find space to take out additional fundraising. So what you may well look for in that scenario would be some kind of asset-based lending, maybe invoice finance or a secured property loan, because those are the lending that the banks are probably most comfortable giving, because they're secured as opposed to unsecured lending. Again, that will depend on your confidence that things will recover and you can repay those debts, and also how indebted your business is to start with. But if you do think you're going to need money, applying for it before you're up against it is often the key to getting that, because when you do run out of money is probably the hardest time to raise additional finance. And the thing I'd finish with and pass over back to Esther would be, the most important thing in all your planning is that you must continue to invest. You have to back yourself, no matter how tough things get. But it makes sense to really focus your investment and where you're targeting growth on the areas where there are the best returns, where you have the greatest success of winning pitches or new business, and where your business is the most profitable, because that is, because in a world of limited resources, you're not going to be able to do everything you might want to do. So you've really got to prioritize your activities around that, focusing on the most profitable areas with the highest degree of success. Thank you. I'll pass back.
Thanks very much, Dan. I think it's, the importance of doing that scenario planning and looking at the sensitivity analysis that comes from all those different things that we can't quite predict because we don't have a crystal ball is just so important. So thanks very much for that, Dan. So lastly, we're going to hand over to Tim and Dinar to just help us think about how businesses can help their people to cope during these very difficult times. Over to you, Tim and Dinar.
I'll go first, shall I, Tim? Okay, so I thought first of all it would be worth sharing some recent findings from the ONS to get some context on the scale of the problem at the moment. So at the moment we've got 77% of UK adults who are worried about the rising cost of living, not really surprising, and 50% of those who are worrying nearly every day. So that is an awful lot of worrying going on, and clearly that's going to have an impact on employers. So employees who are worrying, their mental health obviously will suffer in general. They're not going to be performing at their best, more than likely. They're not probably going to be as productive. They're much more likely to be absent, and considerably less trusting of their employer as well is definitely one of the symptoms when you're in this kind of climate. And so as a result of that, some of the other symptoms, we've got things like industrial action being on the rise, as we've seen in numerous industries. And us in the consultancy team have actually seen a definite increase in employment tribunal claims received by our clients in recent times. And a fair bit of case building as well going on. So where employees haven't necessarily got a great case or a strong case at all, or they're just creating spurious claims, is definitely on the increase. And we've noticed that as a team. And it kind of stands to reason when people are in a bit of a despairing state, as it were, they feel like they've got nothing to lose by raising an employment tribunal claim, for example, and possibly something to gain. So they've got every reason to think about doing that. So to mitigate the impact and the risks, there are some things that employers can do. So the first thing is have an employee wellbeing strategy in place, and that will cover all aspects of wellbeing, including mental and financial. And in terms of the financial wellbeing strategy, is about providing access to financial education, access to relevant information and advice, and as well as access to helpful financial products as well, and ways to break the stigma of talking about money troubles, because I think historically, it's not been something that's been very openly discussed in the workplace, let alone anywhere else, to be honest. So with regard to education, so a lot of organisations now have something like a financial wellbeing hub, where there are links to the employee assistance programme, links to debt helplines, financial wellbeing webinars, all the free advice sources that are out there, saving and budgeting modelers, calculators that employees can then access independently and feel like they're having a bit of control over their own financial wellbeing. And taking this a step further, arranging for specialist financial advisors to come in to the workplace in person, hold clinics, be there to answer questions for individuals as well. I mean, that's obviously taking it that step further, but I'm sure it would be much appreciated. In terms of products, payroll deducted savings schemes is something that's being more wanted by employees, understandably, because it makes saving easier for employees, because it's automated, it's habitual, they don't have to think about it, they're just getting money saved for them. And then we've got things like flexible and remote working. So if you can allow your staff to work remotely, it does save them things like commuting costs. But the flip side to that is that obviously with energy costs rising, they might not want to be putting their heating on when they are working at home. So if it's even possible to provide or pay for a working space which is local to somebody's house, so they don't have to commute far into an office necessarily, but they might be able to commute somewhere quite locally. If that's even an option, that's something to consider. Simple things like cash flow for people, pay expenses in advance rather than people wait to pay out of their own pocket for things, for business expenses, and then having to claim it back, will all help. Salary benchmarking also as part of the strategy. So undertaking salary benchmarking against your competitors and the general market will go some way to making employees feel A, that their employer cares that they are paying them fairly, and B, that they are then paying them fairly. So it may increase the level of trust if you're open about what you're doing there. Plus, I've been having conversations with clients about whether to give a cost of living pay rise. And it's obviously not as simple as if inflation goes up, salaries go up. Salaries are driven by the supply and demand of labour, which is affected by many factors. So, and one of those things is where a lot of my clients have got new recruits who are earning significantly more than the existing staff that are doing a similar job due to the candidate-led market that we found ourselves in recently. So to give an across-the-board cost of living pay rise won't necessarily solve that disparity. So I've spoken to a number of them about benchmarking, going out to market, seeing what the market rate is, increasing salaries for those who need to be brought up to the market rate, and then combining that with one-off cost of living payments based on inflation, so that people still feel that they're getting some level of financial support. And as with most things when dealing with people, a one-size-fits-all approach rarely works. So, I recommend reviewing the employee demographics that you have in your business. Consider what will be valuable support for the different elements of the workforce that you have. For example, if you have got staff of, starting a family age, they will be concerned about your family-friendly policies and offerings. And this can be the difference between someone being able to survive financially or not, and the difference between them staying or leaving your business as well. I've been talking to a few of my HR colleagues recently, and I know that family-friendly benefits is a question that's coming up more and more frequently at interviews. So, standing out in the market, and also coming from the point of view of being a supportive employer for your employee demographic, it's definitely worth thinking about what you're offering in that arena and all the others to fit your demographic. And just talk to people and find out what will be helpful for them before implementing any new support or benefits. People who don't feel looked after during this tough period will vote with their feet, and once the economy bounces back, they're going to be on the move. So my advice is doing nothing isn't really an option.
In the last minute now, everyone, those who know me know I talk quickly anyway, so I'll squeeze in what I can. So these are conversations we're having with clients at the moment. So there's the 1.25% national insurance saving kicks in November. Speak to your payroll provider, make sure they've got their act together. A number of payroll providers are sounding warnings that their software won't be updated in time. You need to put pressure on them to make sure that happens. Employees will be expecting that 1.25% extra in their payroll. Some employers are considering having the employers saving the 1.25%, the employers saving paid as additional salary as well, because it's viewed as cost neutral. It was priced into the budgets anyway, so that would be a 2.5% pay rise for your employees. That's cost neutral, depending how you look at it. The home working arrangements, most people became familiar with the £6 a week that could be claimed or paid during COVID. That £6 a week is insufficient given current energy prices. You can actually agree with the revenue a higher rate if you can substantiate it. That involves a little bit of work with your employees to see what they're spending, but you can pay a higher rate, and that's tax-free. Of course, a tax-free payment to your employees is much more valuable than an extra salary that's going to suffer tax and national insurance. As ever, always push salary sacrifice for pensions. Salary sacrifice for pensions is a much neater way of getting the tax relief, but it saves the employees the national insurance. So those employees who are sort of earning, up to the £50,000, the employees' national insurance is at 12%. That is a saving for the employee. They will benefit from that as additional earnings. So where you haven't fully implemented salary sacrifice for your pensions, do revisit that. It's something very easy to do. Lots of tech platforms exist to make that process very easy. I'll do one more. Deloitte have been in the press a lot because what they've said is if your employees are opting out of their pension, they will actually pay the employer contribution they would have paid as additional salary. And that rather does encourage people to opt out of pensions, which is on one level a little irresponsible of an employer. But the messaging Deloitte and actually I quite like that it's a temporary measure. It's a cost neutral pay rise that the organisation can give their employees for a period to get through the tough time, which will probably be over the winter. Esther, I've probably got 5 or 6 more, but I know we're at time, so I think
Go
we'll
on,
probably
Tim, quickly. Given that most people probably don't have a meeting until 11 o'clock and they can drop off if they want. Let's.
I'll do just a couple more. So don't forget, you can, going back to Dan's point about what the business can afford, businesses can make tax-free loans to their employees. Those loans are tax-free up to £10,000, so no benefit in kind up to that level. A lot of businesses we're seeing are making some loans available to their employees. Now that creates all manner of difficulties. If the employee leaves, how do you recover it? But it's a really meaningful thing to do to your employees to help them through. So if the employees need cash flow, it doesn't have to be pay rises and bonuses. You can actually lend the money to your employees and then have it recovered from net salary over a long period. And then I guess there's other things like canteen expense exemption. A lot of employers are providing meals for their employees. One, to encourage them back into the office, but actually saving your £10 in Pret a Manger because the organisation's putting on some food actually is a nice thing to do. And it, we found in our organisation it's quite meaningful and people do appreciate it.
And that has to be available for everybody, doesn't it, Tim?
Yeah, it is. But I mean, in an office, so you can do it office by office if it's not appropriate in every office if you don't have the space. I get into some sort of in the follow-up. We'll do the full list of everything employers are considering because there's lots of other things. But I'm conscious we are at time and we do try and finish on the button. And Esther's there giving me the look.
No, not at all, not at all. No, thank you, Tim. And luckily you do talk quite quick, so you can cram lots of things in. So, well, thank you everyone for joining us this morning. We'll wrap it up there. Like I said, this is recorded, so please do share with your peers and please do fill in those feedback forms so that we can get some ideas about what we cover in future webinars. So, like Tim said, we'll be following this up with some top tips because I think that would be really valuable for everyone to have a read through and again to share with people as well. So thank you very much for joining. Thank you panelists, our regular panelists, and thank you very much Peter for joining us from our Arbuthnot Latham as well.
Thank you.
Thank you indeed. Have a good day everybody.
Take care.
Thank
Bye-bye.
you.
Bye. Bye.